Hello, and welcome to today's podcast on sustainable passive income strategies for 2025. If you're anything like me, the idea of making money while you sleep is not just appealing, it's the ultimate dream. But the big thing we need to remember is that sustainability is not just important, it's absolutely crucial to keep those income streams flowing consistently. Over the years, I've honed strategies that not only kick off passive income, but ensure it stays strong for the long haul. Especially now, with the financial landscape evolving with digital assets, ESG investing, and new regulatory frameworks coming into play in 2024 and 2025, it's more important than ever to have a strategy that's built to last. Let's jump into these practical tips to help you craft a sustainable passive income strategy. First up, diversification. It's one of those classic lessons you hear about, but trust me, it's vital. I learned early on not to put all my eggs in one basket. Diversifying your income streams means that if one stream falters, others can pick up the slack. Imagine having a combination of rental properties, dividend stocks, digital products, peer-to-peer lending, and even cryptocurrency staking. This creates a robust financial safety net that can handle almost any economic storm. Data from 2024 showed that individuals with diversified income had an average net worth 30% higher than those relying on a single source. But it's not just about the numbers. Take Sarah, a client I mentored. She started with just dividend stocks. When interest rates shifted dramatically in late 2024, her yields dropped. But because she'd also invested in REITs, created an online course, and owned rental property, her overall income actually increased by 15%. The rental market was booming, and her course sales skyrocketed as more people sought financial education during uncertain times. Understanding how different assets move in relation to each other is key. Real estate and stocks don't always correlate. Digital products can thrive in downturns when people seek affordable solutions. Bonds often perform well when stocks struggle. This is about resilience and the peace of mind that comes from not being dependent on any single economic factor. Next, let's talk about investing in sustainable growth that goes beyond just being green. I'm talking about investments that are inherently designed for long-term growth and stability. This could be in the booming green energy sector, which is expanding annually and driven by government incentives and consumer demand. But it's more than that. It includes businesses with strong ESG practices, companies that treat employees well, operate ethically, and focus on long-term success. These businesses often outperform their peers over decades because they're built on solid foundations. Consider companies like Microsoft, which aims to be carbon negative by 2030, or Unilever, integrating sustainability into every aspect of their business. Intellectual property is another fascinating area. Patents, trademarks, copyrights, these often appreciate significantly over time. I've seen investors buy royalty streams from music, books, and software patents that generate income for decades. Once created, intellectual property offers revenue with minimal ongoing costs. Real estate in growing metropolitan areas fits this category too. Cities like Austin, Nashville, and Raleigh show consistent population growth, job creation, and infrastructure development, supporting long-term property value appreciation. The goal here is to invest in assets that are future-proof, not just fleeting trends. Now, focusing on low-maintenance opportunities is crucial for truly sustainable passive income. The idea is to make money without constant active management, so you can pursue other interests. This is why I advocate for investments like real estate investment trusts, or REITs. They give you real estate exposure without landlord headaches. Broad market index funds provide instant diversification across many companies with less hands-on management. Imagine the difference between owning a rental property directly versus investing in a REIT. With direct ownership, you're dealing with tenant calls, maintenance issues, and vacancies. With a REIT, professional managers handle all of that, and you just collect dividends. Automating as much as possible is a game changer. Platforms like Vanguard or Schwab offer auto invest features, so your investments work for you without lifting a finger. Consider dividend aristocrats, companies that have increased their dividends for at least 25 years. These are consistent cash flow generators. Companies like Coca-Cola and Johnson & Johnson have been paying and increasing dividends for decades, requiring nothing more than the initial purchase decision. High-yield savings accounts and CDs offer lower returns but provide passive income with zero maintenance. Some online banks are offering rates above 4% in 2025, making them excellent foundational components for a passive income portfolio. Finally, staying updated with tax implications is crucial. Taxes can be a real headache if you're not prepared. It's frustrating how often people overlook this until it's too late, costing themselves thousands in unnecessary payments or penalties. Understanding how different income streams are taxed can save you money and prevent surprises. For instance, capital gains from stocks are taxed differently than rental income or dividends. Being proactive about tax planning can significantly influence your net income. In conclusion, creating a sustainable passive income strategy involves diversification, investing in sustainable growth, focusing on low-maintenance opportunities, and staying tax-savvy. By following these principles, you're not only securing your financial future, but contributing to a more stable economy. I hope you found these insights helpful. And as you embark on your journey to sustainable passive income, remember, it's not just about the money. It's about creating a life where you're free to pursue what truly matters to you. Thanks for tuning in. And we'll catch up again soon with more tips and insights on building a successful financial future.